others will trickle in as we go here. But thank you everybody for joining tonight's JUMPinar. If you're unfamiliar, this is Jumpstart Germantown's bi-weekly series, which we host several different speakers to join us for different topics in real estate, particularly special topics that we can't cover during our official training program. And we kind of take some time aside here on Wednesday nights to do a deep dive on these topics and get as much expertise as we can out of the speakers that we have, and also field questions from you in the audience. So we're looking forward to having you tonight. This is our virtual format. We also do have in-person events. Usually we alternate, but be sure to check the calendar on our website at jumpstartgermantown.com if you want to look at what upcoming JUMPinars we have to sign up for. But I'll tell you all about that at the end and give you links to find out more information. My last plug before getting started is just that Jumpstart is currently lending, and we are now open to any properties in the city of Philadelphia. So we're happy to take a look at your projects and receive your loan applications, and we'll get back to you as soon as we can. So please do apply for a loan if you are interested in looking at a project. And also our training program is enrolling now for the September to October program. So that starts on September 26th, and that will be all in person, held at our office in Germantown. So be sure to head to our website, again, jumpstartgermantown.com, and take a look at our training program application and see if you'll be able to attend. So yeah, that's my little short intro. Now we're going to jump into our speaker tonight. His name is Stephen Arrivello, and he is the president of Axcel Capital Group, and they specialize in commercial projects and sort of a larger level of real estate development that I think we're familiar at Jumpstart, and maybe that you might be familiar from the training program. But he's an expert in this topic, and I'm really looking forward to hearing from him tonight. I'll let him introduce himself, but thanks so much, Stephen, for joining us, and thanks for being here.
Certainly, Derek. Thank you. Thank you so much for the kind words, and I hope to live up to your expectations.
Well, so just a background for those who don't know Stephen. He also spoke during our Jumpstart 2.0 program, which was, I want to say, man, that was almost probably 2 years ago now. It was a little pilot project we had at Jumpstart to see if we could develop a training program for commercial real estate developers and people who are moving out of that world of residential real estate and starting to take on bigger mixed use or commercial only projects. And Stephen shared a wealth of knowledge to sort of a higher tier of experienced developers. So people who, had completed, I think it was at least 10 projects was the requirement to be in that program. So we definitely spoke on this topic before, but I think it was a lot higher level and maybe a little bit more conversational than your presentation will be tonight. But that's our topic tonight, which is commercial rehab financing. So again, it's making that leap from a residential rehab to a bigger commercial new construction or a project that basically exceeds what we teach and are able to lend to at Jumpstart. So Stephen, why don't you introduce yourself a little bit more and let us know really what that difference is about residential and commercial real estate.
Sure will. I'll give you a little background. First of all, can they see my screen?
Yep.
So I'm not really sitting in Greece. This is a picture from a trip my wife and I took in a couple of months ago. We actually did a cruise, which was great. And I'm sure when you guys, if you haven't done any cruises, you're probably anxious to get out there. Cruising is great. It was my first one, so I highly recommend it. Do the Mediterranean. So I'm sitting in Philadelphia. I am a lifelong Philadelphian. And as Derek mentioned, I own a firm called Axcel Capital Group. We are commercial loan brokers. We specifically finance commercial real estate projects, whether it's development or rehab or renovation, any of that stuff. I've been a commercial lender back in the day, worked for a couple of banks, lending money, and made the move into brokering probably 15, 20 years ago. I also have done some real estate development, and some rehab. So I have a hat, I can wear my rehab hat. I'm going to try to, put myself in the shoes of the folks that are on the call tonight. And to Derek's point, I'll keep it as conversational as possible. I know we've got varied levels of folks on the call, and if something might seem too basic or a little too advanced, bear with us. We'll get to the whole spectrum, hopefully. And if there are questions, we want this to be interactive. So get them in the Q&A or the chat, Derek, however you like that to happen.
Yeah, good point. Let me remind everybody, we have a Q&A function. So any questions you have for Stephen as we talk here, just pop them in there and we'll either ask them as they come up or, save a bulk of them till the end in our last 15 minutes or so. So Stephen, why don't you get us started by kind of defining commercial real estate financing versus residential real estate financing, just to give you an easy out of explaining residential financing. That's what Jumpstart is. We finance single family duplexes, row homes typically in Philadelphia that are for residential use only. So Stephen, why don't you tell us the difference between financing for either of those categories?
Sure will. There's a big difference. And by the way, I'm very familiar with the Jumpstart lending program. Folks, if you can take advantage of it, do it. They are very good lenders. Their rates are very, very good. And I've taken advantage of it myself for some projects. So absolutely take up on that, because everything, once you step into the commercial world of financing, everything is more expensive and harder to do. And I'm gonna qualify that. So for example, in residential financing, if you can get, let's say you go and you get a mortgage, you can often do what looks like a residential mortgage for a commercial project, for an investment project. Let's just say it's not commercial, right? You're gonna rehab a home. You can often get a 30-year fixed rate loan, just like you would on your home. Might be a little bit higher rate interest, but it's going to be high leverage and long-term. Commercial doesn't work that way. Once you step into commercial rehab, and I guess what I'll talk about now is, let's talk about some home rehabs. Does that make sense, Derek?
Yeah.
So
yeah.
you're gonna buy a house and you've maxed out on your sort of FHA type financing, or even your Jumpstart financing, and you've got to go to a commercial bank or commercial lender for rehab. Generally speaking, your rates are going to be much more expensive, right? So, and listen, we did this 2 years ago. Just even last year, rates were great. Today, I mean, not so much, right? Historically speaking, rates are still very low, and you got to keep that into perspective on the total cost of a whole job. But commercial financing will be more expensive than residential. There's just no two ways about it. What we're seeing, and so on rehab lending, rehab lenders out there will go to, sometimes they'll go to 70 or 80 or 90 or even higher percentage of ARV, right? So this is generally the way the rehab lenders work. They work on a percentage of loan to cost and also loan to value. So a rehab lender would look at a property. Let's say you're going to buy something for 100 grand and you're going to put 100,000 into it. You got a $200,000 project. The lender may give you 80% of that if at the end of the day it's worth 250, let's say, right? It's not the exact math, but this is the way the rehab lenders think about things. And they may charge you 7, 8, 9, 10, 11%, depends, right? And before anybody gets shocked by that, what I would urge you to do is keep your rate in perspective, right? Keep it in the perspective of not just the rate itself, what it's going to cost you. I'm sure everybody knows how to do a pro forma. I know Jumpstart teaches us very well. And in your pro forma, you've got a line item for financing costs, right? So if you hear 11% and it's going to take you a year to do the property, you know what? At $100,000, it's not necessarily $11,000, right? You're not going to draw all that money at once. You're going to draw it over time. You're going to pay interest as you draw it generally.
Right. And Stephen, just to go back to what you said about it's not important to take in the other factors of the equation, not just the interest rate, because I know high interest rates are like the hot topic of discussion and everything right now. But I will say a lot of the people, or a few of the people I should say I've spoke to recently, have compared it to 18%, 19%, 25% interest rates they got in the 70s or 80s, I guess. And it didn't click until it's because the properties were $10,000, right, for a single.
I didn't want to bring that up and show my age, but that's absolutely right. When I say they're historically low, I remember 20% interest rates. I remember that. And now it was a whole different world back then. You had inflation from gasoline. You had all sorts of crazy, crazy stuff going on. People can read into economic history. It's fun to do, but remember, it's not just the interest rate, right? Once you step into the commercial world, again, you're going to be dealing with a commercial lender, and you're going to get to know your commercial lender. If you're doing residential mortgages through a residential mortgage broker, you never really know who the lender is. You might know the broker, but you don't know the lender. when you're dealing with a rehab group or a Spring Garden Lending or whoever's out there that's funding these deals, you're getting to know that lender. They're getting to know you. They're getting to know the project. So that's another thing that's a little bit different, right? You will get to know your lender. Your lender will underwrite it. They'll present it to a credit committee. And it's not just your project anymore. Now it's you, right? So they will look at you personally. They'll very likely ask you for a personal financial statement or a PFS. Again, if this is rudimentary, bear with us. We'll get to the hard stuff too. But they'll ask you for documentation you might not otherwise be asked for. They may require the property be in an LLC, right? A separate entity, separate than you and or your spouse or whoever owns this property. So and that in Philadelphia is a very interesting consideration. You need to think this through when you're buying properties. You probably don't want to buy them in your name anyway, just to limit your liability. But from a financing standpoint, chances are you're going to have to put them in an LLC. And if you buy them in your name and then you have to transfer them to an LLC, you will pay transfer tax. Keep all these things in mind, right? So commercial probably needs to be in an LLC. And then I guess maybe without getting too high level, I want to talk just a little bit about what is commercial versus residential. Well, any property with more than 4 units, right? Up to 4 units can still be considered residential, but 5 units and anything that's not a house that people live in is commercial. So a self-storage facility, a warehouse, a retail store, a commercial store. These are all commercial properties.
Cool. Yeah, I think that's an important distinction to make, because a lot of people think commercial must mean there's some business use to it or some, other income generating aspect of the unit. But that's important distinction, I think, for jump starters, because they can use Jumpstart even for financing for a triplex or a quad. But as soon as it gets into that commercial territory, and is that by the city classification too?
That's just lending. That's lending anywhere in the country. Has nothing to do with anything. It really has to do with the FHA. It's what the FHA will find. So FHA mortgages will finance up to 4 units. And they're those really great mortgages that if you can get them from your loan broker, get them.
Gotcha. So that's an industry-wide, understood concept that anything bigger than 4 is commercial. Got it.
That's correct. That's correct. So that's an important distinction. And by the way, if you're going to be in any of these different what are called asset classes, right? The financing will be different as well. So if you want to try to finance an office building today, forget about it. Office is dead, right? Unless you've got a lease in hand, which comes into play in underwriting. Or if you're going to do a multifamily deal, let's say you got a 10-unit building in West Philly, that gets very, very attractive financing, relatively speaking. And certainly compared to offices or something else, it might not be as attractive as an asset class. As far as leverage goes, right? If you're used to getting 90% leverage on a rehab loan, I mean, you might get it from the rehab lenders out there today, but again, the rates are going to be much higher, and you're going to probably need to expect not to get the 90%. You're going to need to expect 70, 75. If you get 80, 85, you're on the good side. And those lenders are out there, but you'll pay for it. And only with the caveat that they look at the ARV, the after repair value, so that you've got to be within a certain threshold. You need you to be 70% of ARV. So when you do the math, you might not get all the money that you need. You're going to have to come out of your pocket, put more equity in it, and then your return on equity gets affected by that. So it's all math. You guys know how to do the math, I'm sure.
Yeah. And just to clarify, so you said use the word leverage, where that means your LTC or your LTV, right? Which might be used in a residential deal.
Yep, exactly. And LTC, LTV, loan to cost, loan to value. Most of the times when you're talking about rehabbing an existing building, your lender will talk to you about loan to cost. How much money will they give you compared to the cost? And that has to do with, the correspondence of that is, how much money are you coming out of pocket with? Your lenders will always need you to come out of pocket.
Yeah.
Go ahead.
I was just going to ask, so in addition to these different characteristics of the building, its type of commercial use, or the number of units and the location, all these things that play into the equation, how about the investment or the exit strategy that the borrower is looking at? So I'm just thinking of with the Jumpstart loan, when you go to apply, you choose buy and hold, meaning you're going to rehab and rent it out and refinance, or buy and sell, where you're just going to buy it, fix it up, and pay off our loan using the proceeds from a sale. Is in commercial lending, is it there still those two buckets, or is it always one or the other? What are we looking at?
Great question. It's a great question. And here's the good news, folks. There are a lot of lenders that have come into this space in the last 10 years, right? So there's a range. And Derek, to your point, certain lenders, like the rehab lenders that I talk about that are going to give you 70, 80% loan to value, loan to cost, based on the ARV, they're going to be a short-term lender. They're going to lend the money at 7, 8, 9, 10, 11, 12%, and they're going to want it back in a year. So they are going to want an exit strategy. And your exit strategy is going to be, you're going to refinance with a permanent lender. That lender itself is not a permanent lender. They're a short-term lender. Who are your permanent lenders out there? Your commercial banks, your community banks, Hyperion banks and Truist, and all the banks that we all know, maybe Wells Fargo. It depends. So in answer to your question, you have at the one end of the spectrum, you have the rehab lenders that only want to put money out there short-term, but you've also got certain lenders that will lend you the money on the construction basis, right? The rehab basis. And then it will roll into what's called a mini perm or permanent loan.
Mm-hmm.
Now, generally speaking, the banks that are doing that sort of rehab plus permanent are not going to give you the leverage that the rehab lenders will. Not to be too complicated about it, but there's a give and take.
Yeah, and
the community banks, want to give you a permanent loan as well. They're going to give you less leverage. They're going to want you to have more skin in the game.
And is that because they're taking, like the reason they'll give you less leverage is because they're taking on more risk, assuming that you're going to do the construction and get it to an end product like that?
Yes. Well, the reason they'll give you less leverage is because they want to take on less risk.
Right. Yep.
Right.
And it's more risky to finance a project that hasn't been built yet than one that is finished, right?
The most risky project that is a ground up, out of the ground development, because who knows what's going to happen. The second most risky is a rehab project, because again, there's no guarantee on how contractors are going to work. There's no guarantee to whether you're going to find things that are contingent, right? You're going to find things that are going to increase the cost of the project. So yeah, so it's a more risky proposition in terms of the rehab. And to your point, exactly, Derek.
Okay, great. So I want to ask you next about return on investment and that term that for Jumpstart, and again, I'm kind of using ourselves as the example of a residential lender, which I think is useful. But when we're looking at a deal, we want to make sure that the net margin is 20% or that the debt coverage ratio is 1.25. We're not as concerned about the borrower's return on investment, right? Because we want them to get experience. We're into getting their first project under the belt, build some equity, and kind of go through this process without thinking about sort of the bottom line, right?
Right.
But in a commercial deal, like you said, there's a lot more risk. Like there are typically much larger project sizes, and it matters more, right, for the borrower what their return on investment is than I would say with a smaller project.
That's a good point. It's a good point. Commercial lenders will look at your return on investment. In other words, they will want there to be a return on investment. They'll want the developer to be experienced enough to show that they can make money on projects. They don't want to. It's the chicken and egg at this. They don't want to fund first-time investors, right? Which is why it's such a great resource to have a Jumpstart available, right? They don't, a commercial guy is not going to do your. Now, I'll say that, but I'll also caveat it, because again, the commercial folks look at a whole number of factors, right? Including your personal net worth, right? You may hear the lender ask you, well, what's your net worth and liquidity, right? And what they're asking you is, gee, if this loan goes bad, how am I going to get my money back? What do you, Mr. Borrower, Mr. and Ms. Borrower, have you're going to be able to sell or give me cash to get me out of this loan? Mm-hmm. And that's consideration. That brings up another concept, which is personal guarantees.
Yeah. Before we get to personal guarantee, just return on investment, is there like a percentage threshold you would advise people against, or is it kind of depending on the deal?
There's not. I mean, that's another really good question. here's what I will say to that. The more equity you have in a project, the less important that becomes from a lender's standpoint. So I've never, as a commercial lender, there's never sort of been a threshold. Hey, we want to see a 20% ROI on this. It's really never been a conversation. It's more about, does the project make sense? Is it feasible? Is what you're saying, do the comps bear out what you're saying, right? What you think you're going to get for this property when you're done with it? And frankly, as long as we get our money back, we don't really care about what goes in your pocket, right?
Okay, so let's go back to personal guarantee. What this might be new to some borrowers, right?
So PG, personal guarantee, what it is, it's exactly what it sounds like. And it may shock you as a borrower, but a commercial lender will generally ask you for a personal guarantee. What does that mean? It means you sign a document that says, if I don't pay this loan back, you, lender, can come after my personal assets to claim, to sell them and to get your money back. And that sounds scary. And it's important, right? It doesn't need to be scary, but it's very important. What it comes down to is the bank or the lender is asking you to they're saying, hey, listen, if you're not going to personally guarantee this loan, why would I even make it, right? I'll have some borrowers come to me and say, I'm not giving a personal guarantee. Well, then you're not getting the money, right? You're just not it's not happening, especially at this level.
Right. It's like a baseline of confidence you need to show, right?
Baseline of confidence. And the fact of the matter is, if you're dealing with banks and not these rehab lenders, now, again, some of the rehab lenders will do a non-recourse loan, and that non-recourse means no personal guarantee, but they're charging you. They're charging you points. They're charging you high interest rate. When you folks grow up to be big developers, maybe some of you are, you'll be able to garner non-recourse loans. Once you've got a big enough balance sheet, you can go to a bank and say, listen, I'll give you a limited personal guarantee, or I'll pledge some asset, but I'm not going to give you what's called a blanket personal guarantee. But that doesn't work in this market. You're talking about, under, tens of millions of dollars of project cost. It just doesn't exist out there. You got to make sure that you're going to be okay with your personal guarantee. And if you're married, you got to talk to your spouse about it too, because generally it covers all that. It's not going to cover the home. They're not going to come after your house, right? But they could come after your stocks, or if you've got other real estate properties, they come after that. But when I say come after it, it's only to the extent of the money that you borrow. Right? Keep that in mind. So again, it sounds scary. I don't mean it to be scary, but it's important, and it's a factor of life in commercial financing.
Yeah, great. Okay, so real quick before I move on, I want to just remind everybody that we do have a Q&A function. So I haven't seen any come in yet, but please do.
We're either doing a great job or everybody's sleeping or eating dinner.
Right. Well, usually how it goes is there will be none all the way through, and then the last 15 minutes we get bombarded. So I just want to remind everybody, ask your questions now, so we can make sure we have time for them by 8 o'clock. The next thing I want to ask you about, and this is the last, I guess we'll talk about terminology differences. You mentioned comps and how, those obviously need to support your ARV or your rental amounts. There's a term that I hear only used in commercial real estate development, which is cap rate. And it's something that jump starters will try and reference to me, and I'm like, I don't understand that. I can't wrap my head around it at this point, but I do know it's out there and people want to understand it. And why don't you explain for us what that means, and how that kind of compares to the process of asking a realtor to pull 3 comps, right? What's the difference there?
That's a great question. Good line of questioning. And this is where we'll really get into some meat of it. So cap rate is also known as a capitalization rate. And it's essentially, a cap rate is a mathematical formula. And what it does, cap rates generally represent the risk in the marketplace of a certain asset. So let me do a really simple one, right? And the way you get to a cap rate is you calculate your net operating income, right, from any property. So so what's net operating income? Well, it's all of your rentals, less your vacancy, less your management, less all of your expenses, your taxes, your insurance, your reserves. If you're paying the common electric in the hallways, you take that out. And basically, it's what's left over after you run your building to pay either debt or to pay your, if you don't have any debt, you put it in your pocket, right? So you think about it like cash flow. NOI is very important. Um, as an aside, a lot of people, if you're doing what's called a value add, you're buying something and it's got some sort of income in it, and you make an improvement to it, you increase the rate, the rentals, you improve your NOI. Okay, so your NOI is your net operating income. Basically, you divide that by a percentage, and the percentage, here's where it gets not fuzzy, but this is where some judgment is involved, and it's also asset class related. And cap rates are highly influenced by interest rates, right? They're correlated, right? So as interest rates rise, cap rates generally rise. And the way it works is, let's say you've got $100,000 worth of NOI. Very simply, you use a 10 cap on it, right? And you say, okay, what's the value of this property? Well, I'm going to cap it at a 10 cap. And that means your property is worth $100,000 divided by 0.1 or 10%. And it's $1 million property. That's the value of the property. And commercial brokers do this all the time. And cap rates have the advantage of basically valuing not necessarily the property itself, the condition of the property, and whereas in a comp, you'll look at the property, you'll see how many square feet, how many bedrooms, and how many bathrooms, and then you're going to make adjustments for it. And that's how you do a comp analysis. What you do with a cap rate is you just take the income stream and you divide it by the cap rate, and that's your value. So what it does, it eliminates sort of these unique characteristics of each property, which we know every piece of real estate is unique, right? But it allows a comparison of similar types of property based on the income that they generate, not based on what they cost to build or what they would cost to replace. And that's a fundamental difference in commercial and residential.
So, and I guess this is like a chicken or the egg question, but what comes first, like the cap rate or your end price? So I guess what I'm asking is how does one determine what cap rate they should use? Is it like by a neighborhood basis, or is it just something that you need to guess on? What's the?
Not a guess. I mean, to a degree, it is a guess, right? But to a large degree, it's an experiential factor. It's experience, right? So I know right now that mid-level multifamily buildings in Philadelphia proper are trading at a 6 cap. I kind of know that, right? So
right.
I see a building come along with an NOI that's X dollars, and it's a mid-sized building. I'll cap it at a 6 cap to see what the value might be. And if I could buy it for a lot less than that, then it gives me reason to look deeper into it, right? So I mean, it's not something that you're just going to make up. You're not going to make up a cap rate. Now, there's a lot of research out there. Marcus and Millichap, for example, does a lot of research on cap rates, and I would suggest to everybody to go to Marcus and Millichap's website. You can sign up for the research for free. They'll send it to you, more stuff than you know how to deal with, and they break down cap rates by asset class, by area. And it's actually if you're looking to get into the commercial real estate knowledge base, that's a very good place to start. Most of your big brokerages will have similar types of information. So,
great. I just put the link to Marcus and Millichap in the chat there, so hopefully people can check it out.
Cap rates are confusing. They're different for asset class, right? So office cap rates are going to be really, and here's something to keep your head around. A high cap rate is sort of decreases the value of the property, right? Low cap rates, high value. High cap rates, low value. So office right now is going to have relatively high cap rates, and it kind of doesn't make sense. Doesn't make sense to use cap rates on a single family property. It does.
Right.
The market,
and the reason for that is because I guess there's like the focus is more on that particular deal itself in that neighborhood on that property, right? Whereas a cap rate is taking into effect or taking into account a much larger like scope of the property, right?
That's exactly right. Cap rates take into account the local marketplace, whereas we all know you can be block by block and have serious differences in single family homes, right? But if you've got a 40-unit apartment building on the corner, it's going to be much like a 40-unit apartment building, maybe 20 blocks away, right? So it does take into account a bigger marketplace.
Great. So my next question here is about the debt service coverage ratio, which is something that people are probably familiar with if they've gone through Jumpstart. When we look at a buy and hold project, so just for your reference, like we estimate 75% loan to value with a 7.5 interest rate at 25 years term. So that our spreadsheet, auto calculates what the permanent bank loan might be and takes into account those, like you said, your net operating income minus your expenses, and then spits out that DCR. And we look for 1.25. And if we get an application that's 1.1, we know they're not going to be making enough every year or every month per se to pay off their debt service. That's like the only context we have it for in Jumpstart, and we're always kind of analyzing it in that case where there's like a rent, and if you have two rents, that's better than one because it increases your debt coverage ratio. But our commercial loans, I mean, like you said, everyone is being either refinanced at the end of that year or upfront with what would you call it, like a mini perm loan?
Yeah, mini perm. It'll roll into mini perm. I'll pick up on that. I'll pick up on, and I'll pick up on that because debt service coverage ratio is also very important at the commercial level. And the way Jumpstart underwrites it is the way you're going to see most commercial lenders underwrite it on a permanent basis, right? DSCR only makes sense in a permanent basis. If you're doing a construction loan, there's really no interest in what the debt service coverage ratio is because you're not generating any income because it's a vacant property. And I should probably say, I'll just dump this in there. Commercial loans are generally interest only, right? You're generally not paying principal during a construction loan. So I'll leave that off to the side. There may be questions about that.
Yeah, great. So just to clarify with the debt coverage ratio, obviously the rental amount and your income is like it's half of that equation. So I like the cap rate accounts for how you calculate the value of the property, right? Or the ARV. How are commercial lenders still looking at like rental comps or looking for,
rental comps. And the common thread here that you just mentioned is NOI, right? So remember, from the cap rate, I told you how to calculate an NOI. It's your income versus less all your expenses.
I see.
Not depreciation, right? On a debt service coverage ratio, same thing. Take your income, take out all your expenses. Now you got your NOI. Well, the NOI then goes to service the debt. So in that example, let's say you've got $100,000 of NOI, and then at a 25-year, 7.5% loan, you have $75,000 of debt service, right? You got to pay. That's your principal and interest, not your taxes and insurance that they escrow, but principal and interest. So your $100,000 over 75 is going to give you roughly a 1.25 debt service coverage ratio. And 1.25 is very common. You'll find that 1.2 is also very common. It'll vary on the lender depending upon the risk and what they request. So now debt service coverage ratio is very important. Lenders will look to, from a reasonable, like you're gonna have a pro forma, or you'll have an actual rent roll, right? A rent roll will be unambiguous, but if you've got a pro forma, then the lenders will look to rent comps, right? They'll look around the neighborhood and say, okay, well, this two-bedroom unit, 2-bedroom, 1-bath is going to rent for $1,850 a month, and that's pretty good, and we believe that. So that's how they'll indicate that your revenue line is reasonable.
Gotcha. Great. Thank you. So and this is my last line of questioning, and then we'll move towards the Q&A because I see some have been entered in there. But I want to ask sort of like the process of working with a commercial lender versus a residential lender. Like for Jumpstart, and this may be because we have a training program that's focused on teaching first-time developers, like we are very hands-on in the application process. We help you fill out your pro forma. We answer a lot of questions about, what you might be able to do to get the deal work or explaining why, like a loan application is denied, not just denying it. Will people experience that same sort of thing with a commercial rehab, or are they expected to come to the table with a pro forma built, with all these pieces figured out, like, is there any level of like what is the loan application process like? Is it like you send an email with your entire narrative of the project scripted out with all the documents together, or do you go online and fill out a form and they contact you later? What do you typically see?
Wow, that's a great question. I'm not going to blow my own horn here, but I will say that a loan broker can be very helpful. Now, a loan broker might charge a point or two, whatever, but a good loan broker will build the package for you, right? You can get caught up in providing too much information, not enough information. But listen, it's not something that you can't do on your own. If you've done a couple of rehabs, I'd say, find a friendly lender, and I'm happy to make recommendations to lenders. Some of the there's a guy named Joe Sweeney at First Trust Bank who is amazing, right? He loves to fund folks that are coming out of like where you get them, and where Jumpstart gets them, and build them to the next level. Joe Sweeney's tremendous. I'll get you his contact details.
Great. Yes, please do. I'm more than happy to include any info like that in an email to everybody tomorrow. Yeah.
Yep. And but so there are good lenders out there, and you don't have to have a broker, but you do have to have your house in order. You're going to need to have, at a minimum, 3 years of personal tax returns. If you've got an LLC or multiple LLCs, all of those 3 years of tax returns. You're going to need a personal financial statement. And if you don't have one, again, I can get there's copies out there. We can get that. You're going to need a detailed construction budget. You're going to need to have your contractors in a row, at least to know who they are and to know generally what you're going to pay. And by the way, you won't be able to close on a loan until you have construction numbers, right? It's just, you got to have it together. You'll need to show some experience, right? You're going to need to, so keeping a track of, the projects you've worked on, how you started them, how you finished them, pictures, that kind of stuff. It's all good. Your experience matters a lot, because at the end of the day, these lenders are not really lending on the project. They're lending on the borrower because they're betting that you're going to get it done. So there's a lot of integrity that goes, and it's great to develop relationships directly with lenders. So answer your question, you're not going to go onto a website. Well, there are some websites out there that I think you'll find if people start sort of exploring them, I think a lot of them will be brokers that are sort of putting themselves out there as quote unquote lenders. And if you're having conversations with people, ask the question, are you a direct lender, right? A lot of commercial brokers, unfortunately, for whatever reason, they hide that fact. They try to hide that fact. They might call themselves a correspondent. They may say, oh yeah, we lend on some of our deals, but then we arrange capital for other folks. Look, if you're a broker, tell me you're a broker. I know what I'm dealing with. I've never had a problem. Okay, so I'll just say that.
Yeah, that's great. Great advice. Great advice.
And listen, by the way, anybody can contact me at any point for anything, any questions at all. I'm not charging people. I do very little loan brokering these days because I'm lending money in different anyway. So yeah, happy to help any and all jump starters. So
yeah, we'll definitely be able to send your contact out, as well as any other links or resources you have for us. And I'm sure people will come running with questions. Thank you so much for that great back and forth. I think we covered a lot of information, but I do want to make sure we leave some time for Q&A.
Yeah. I see the questions coming in.
Yeah, so I'll start reading them off here, and again, everybody, please do submit any questions you have for Stephen here, and we'll hope to get them answered. But one last time, thank you, Stephen. That was really excellent.
Oh, you're welcome. You're welcome. It's my pleasure.
All right, our first question here is one for you, I guess, as a lender, from Barry, and he asks, do you finance abandoned factories that would be subsidized by HUD, the Housing and Urban Development, to renovate and rent out in order for it to be used in low-income housing, say a 50-unit building? That sounds like a Ken Weinstein project.
It does sound like a Ken Weinstein project, and it also sounds like a very, very difficult. When I say difficult, I'm not impossible, but when you're talking about HUD financing, very hard to do your first HUD loan, and you're going to need substantial experience to get a HUD loan done. And by the way, I should also say this: generally in the commercial world, when you talk about net worth versus loan amount. If you're looking for a $5 million loan amount, you're going to need to have a net worth of about $5 million. That's generally what lenders think about. So, you know, I'm thinking of the possibilities of this. You know, we take a warehouse and renovate it, right? It's a great idea, or a factory, renovate it. You might have environmental issues that you're going to need to deal with. So there's a lot of pre-development work that needs to happen. I'm sure you've gone through, but let's just take it and assume it's a good project. You know, I don't know if the question refers to HUD subsidizing the tenants or HUD subsidizing the financing, because HUD does both.
Okay.
If you're talking about HUD subsidizing the financing, again, very, very hard to get a HUD loan. It's a construction loan. It's difficult to get a HUD permanent loan, but it's very difficult to get a HUD construction loan. It's sort of the best out there. It's like 40-year fixed term, low rate, 90% leverage. It's the holy grail of construction lending. But again, you're going to need a very experienced developer to do it. Now, I will say this, you know, maybe I don't want to shatter anybody's dreams. You can also partner with someone. Like if you find a project like this and you tie it up with an agreement of sale, maybe go find a developer that has deeper pockets or that could partner with you on something like this, Barry, because great deal. And developers are deal junkies. They want to just make deals with everybody. So if you can go find a deal like this, I would encourage you to try to take it down, try to swing at it, but I wouldn't go into it with the expectation that you are going to get a HUD loan unless you've either done a HUD loan or have brought in a partner who has done a HUD loan.
All right, great answer. And Barry did clarify HUD subsidizing the tenants.
Okay.
But you answered. So great.
Which is probably it's probably voucher based, and that's a whole different line of questioning, because HUD can do what used to be known as Section 8, right? Now they're called something else, or they can subsidize the building itself. And that process in itself has, it's competitive. It's RFP based generally. You go and compete for it with a bunch of other subsidized developers. And so it's a great, listen, I'm friendly with a guy who just sold his portfolio for many, many millions of dollars, and that's all he did. So great line of thought. Go get them. Got
it. All right. And next question here comes from Adam. And he says, this is a great question. As someone with 2 to 3 residential projects under their belt, it seems like making the jump to a commercial project has a lot of challenges. How might you advise someone to convince a lender to take a chance and finance the project, bringing more equity to the table, having geographic expertise, an identified tenant? I think those all sound like great options, and I know you answered this, but specifically for Adam, you know, who's gone through that rehab and refinance process a couple times in the residential world, you know, how can they kind of make themselves stick out, I guess, from other people?
It's a great question, and congratulations on that, Adam. Yeah, I mean, what you said, all of the above, but I would also say that finding the project and nailing it down, right? Putting together a pro forma on it, putting together a package on it, putting together, you know, what you thought, you know, the market comps and why this thing is going to work. And then I would say, start to talk to some lenders. And again, here's where I can probably introduce people to lenders. So that's a good position to be in. And it's basically just do it. I mean, it is Nike. It's right. just do it. Get out.
And we tell jump starters, you know, that their first like 5 to 10 project, they're just going to have to like reapply for a loan and do more walkthroughs, reapply for a loan, go through that process, repeating. So I think that advice, you know, from our perspective is the same. Just go for it and you know, paint your picture.
And also temper your expectations, right? So remember, as you put your pro forma together, you're not going to get 90% leverage. You know, you're not going to get a 30-year fixed financing. So, you know, it's sort of now, you know, and maybe I can help with this is tempering, you know, the project to what the financing market will support, right? You want to go in there and be realistic.
Right. Okay. Our next question here comes from Petra, and they were asking, do you lend loans that are organized from a seller financing loan agreement?
Yeah.
So for somebody who might not be familiar with seller financing, if you could define that, and then, you know,
sure. Sure. Great way to get great way to do a deal without coming out of pocket any money. Get these. So Derek is selling a property for $100,000, and I'm going to go to him and say, "Hey, Derek, I'll give you your $100,000. Will you finance it for me?" And you're going to do some research before you do. You're going to know that Derek doesn't have any mortgages on it that he has to pay off by selling it to you. Or you might say to him, "I'll bring a $50,000. Will you hold the mortgage for 50? That's seller financing. What you're going to find when you're talking to commercial lenders is they want you to, now it's not verboten, it's not forbidden, but they're going to need you to have some skin in the game. They're never going to let you do a deal without any money out of your pocket. So I know these concepts are great. Hey, do a deal without any money of your own, and I highly support them. If you can get them done, you can get a seller, you can convince a seller to hold back a mortgage for you and you don't have to come out of pocket. That's great. But commercial lenders generally don't allow that to happen. You've got to have some of your own skin in the game.
Got it. Next question here comes from Lloyd, and they say, I have a 6-unit property that I'm looking to refinance to a better interest rate. Should I refinance with a debt service or debt coverage service? Is that the right? Is it DSCR? I got it.
You know what Lloyd means.
Yeah, DCSR or a bank, even if the bank has a higher interest rate. What is a good interest rate? That's a simple question, but I think any answer is a good answer to that.
I don't know. And so my question is, and I'm assuming you have to refinance right now, because if you don't have to refinance today, you wouldn't, right? So today's rates are, they could be, so 6 units, I'm not sure what that works out to. I'm not sure if that's $1 million property or $600,000. I just don't know, right? And it does make a big difference. Once you get over $1 million threshold of a loan amount, you can go to what are called the agencies. You can go to Fannie Mae and Freddie Mac, not the same ones that you do your residentials, but these are called agency loans. And those rates today, I think, are in the mid-5s to mid-6s, somewhere in that range. Banks are probably in the 6s to 7s. So in terms of what's a good interest rate, the good interest rate is going to be the one that works for your project. And whereas a bank will give you a little bit lower leverage and a higher rate, an agency will give you a little higher leverage and a higher rate. But again, they're going to want you to be a more sophisticated borrower. They don't necessarily care about your local connections, your local knowledge of the loan officer, right? Whereas your community banks, they're going to get to know you and they're going to bank on you a little more. Whereas the agencies are going to look more to the asset. And again, it's for a little bit more sophisticated investors. So, I'd say shop around and figure out where your best rate's going to come from. And banks will be in the same range, but I would say talk to community banks, talk to Meridian Bank and First Trust Bank and Victory Bank. Just look up your local community banks and go hit those folks up for commercial loans. Okay.
Adam has another question here. He says, how about, and this is a little off topic, but I'm interested to hear your answer. How about what opportunities you see in the commercial market these days? So you mentioned some that have some pitfalls, like an office space or what may be, but what would you say are the opportunity zones right now, or the potential projects that would look more attractive to a commercial lender than something like office building?
Great question. Housing continues to be very, very strong, right? And in this country, we have a real shortage of single-family housing, believe it or not, which is why a lot of the multifamily projects are doing so well, because people can't find homes that they can buy affordably. And so that's also an issue, right? Because you need to make as much money as possible. So, single family conversions in good neighborhoods are still a very, very good bet right now. You can, whether you want to convert it, when I say convert, I mean rehab. Whether you want to rehab it and hold it for yourself, as if the pro forma makes sense, or sometimes it just makes much more sense just to flip it out and sell it, because the single family housing market is so hot today. Other areas that are very hot, I'm not sure if anyone's doing this, but lot development, not much in the city, truthfully, because the the cost basis is so high. I see guys, I'm in graduate hospital, I see folks buying, parking lots and subdividing them and building $4-3 million homes. That's highly risky, right? Because that market, but lot developments, in what used to be the suburbs, right? People would buy a farm and they entitle it, meaning they get the zoning change, and then they would sell lots to home builders. Very strong market right now. But maybe a little closer to home. I think, again, the single family market is very, very strong. There's a lot of money out there to fund it today on both the rehab and the bank loans. It's just a very good place to be.
Gotcha.
The other thing is, one more thing. It was alluded to in one of the other questions. If you can find a commercial property and then have a tenant lined up that's going to give you a strong 10, 15, 20-year lease, that is very financeable. So if they want you to come in and make changes to the property, but they're a strong tenant and they're going to lease it, also a really good place to start looking around for opportunities.
Great. All right. That's a great answer. And it's exciting to hear, even a commercial expert or a person who's lending and brokering commercial deals say that single family is where to be. So that, yeah, that's great to hear. And I'm sure that provides a lot of encouragement to people, because that's also, there's less barriers to entry in that sort of development. It seems it's especially when, like you said, that there's such a desperate need for it here, that things like finding a market rate rent or, a home buyer at, a market rate shouldn't be that. I mean, I say this while I'm reviewing a bunch of loan applications with decreasing sales prices, but
it's good decreasing sales prices if you not if you're financing them on the back end, but if you're buying, as investment or rehabbing, that's good.
Yep. So we'll talk after, Stephen.
Sure thing.
But yeah, our next question here comes from Brian. He says, are the different marketplaces have different cap rates? Where does one find it other than asking an appraiser? Okay, so I guess he's just asking where's a good place to look to start to understand cap rates in different neighborhoods. Brokers.
Talk to brokers. And again, Marcus and Millichap, I actually worked in Marcus and Millichap for a little while in the capital markets group, but the reason I keep bringing them up is they're a very investor-based brokerage. They're in that sort of smaller commercial world, maybe $1 to $10 million transaction size. They do thousands and thousands and thousands of these transactions. I know the guy here that runs the Philadelphia shop. His name is Sean Bucci. There's a bunch of brokers, different asset classes. I would get to know some brokers. Seek them out on LinkedIn. They'll talk to you. They'll give you the time of day for sure.
All right, great. Our next question here comes from Zipporah, and she asks, you mentioned commercial lending is for over 4 units. Could that be a combination of rental apartments and storefronts in the same building? So Zipporah's talking about commercial mixed use.
Yeah, mixed use.
Does
sure.
that?
Yeah. Sure. You could have a building that's got a storefront and 4 units, and that's commercial. Now, listen, I don't want to say, look, I could finance a 4-unit building with a commercial loan. What I'm saying is there's better options out there that are not commercial lenders, right? So okay. That's it.
Damani, and this will be our last question here. Damani asks, when creating your operational costs and accounting for property tax in commercial real estate, how do you estimate this number?
Really good question. And you didn't ask the question, Damani, but also there's a tax abatement, right? So what you'll do is, you'll look at the current tax roll. And in Philadelphia, you will expect that after you buy it, that there will be a reassessment. And who knows, right? If you want to be cautious, in your pro forma, I don't know, double the taxes in 2 years, right? Because that's not unusual in Philadelphia, right? We know that. But what I would say is I would do a little deep dive into the similar properties if you can. You can look at what the taxes, I think Atlas still shows you, or the BRT still shows you the historical taxes. I think you can look at similar properties, or you can see something that's been rehabbed and see how the taxes have gone.
Okay.
There is a calculation, right? There is a calculation that, there's the assessed value, and then they use the millage and they calculate it. So it's just some math.
Okay, great. Thank you, Damani, for that question. That looks like all we got. So thank you again, Stephen, so much for joining us. I'm going to ask you to please put your email in the chat if you would,
Yeah, sure.
so that people have that before we go. I'll also send that out tomorrow, along with some other links and stuff that we mentioned in an email. Oh, hold on, let me, I'm going to copy that into.
Okay. I'm in the wrong place.
No, you're good. I think I just have it set so you can only send messages to me.
Got it.
There we go. Okay. And,
it's really been fun. Great questions. And, I wish all of you super success. You're doing the right thing out there. Get out of your comfort zone and get stuff done. Oh, you have PHCD coming in. Excellent.
Yeah. Thanks again, Stephen. And we'll definitely have to get you in our office for an in-person event. We'll do that.
Love to do it.
Speaking of upcoming events, we got our Think Tank, which if you haven't heard, it's our new event series, which is sort of like a half networking, half problem solving event that we have, and we have pizza and drinks there as well. So that always helps. But please do sign up for that if you got or you should have gotten the email invitation if you're attending this. So definitely check that out and sign up. RSVP is required. We have a limited amount of space, so make sure if you are going to go, you sign up. And then coming up later this month, we have another JUMPinar on the 30th with Odara Jabali Jeter, and they're going to talk about hiring a property management company, because we haven't spoken about that in a little while. And then later on September, our next virtual JUMPinar is with, I believe her name's Rachel from PHDC, and she's going to talk to us about the Rental Improvement Fund, which is a new program that PHDC offers, some grants and other programs for people who are doing, residential rehabs like Jumpstart supports. So register for all those at jumpstartgermantown.com/events and get them on your calendar. And lastly, you can view all the recordings of our JUMPinars at jumpstartgermantown.com/library. And this one will be up probably tomorrow. And I'm also going to, do it as an audio only podcast version. So that'll be available soon. And you can check out everything that we've done in the past there, as well as sign up for anything coming up. All right. Thank you so much, Stephen. Really appreciate it.
Very cool. You're welcome. And say hello to Ken for me, will you?
All right. Will do. Thanks, everybody, for coming, and have a good night. See ya.
Bye now.